Good day, I'm Russell Eastaugh, the African tax lead at Regan Roy, the specialist tax consultants who particularly specialise in tax issues in Africa. And I'm going to talk about a number of issues today, including the recent changes to Nigeria's withholding tax regime. Now, these changes took effect on the 1st of January 2025, and they are quite radical. And people might reasonably ask me, well, what are the changes? Are they good or they're bad? And the answer is yes, some are good and some are not so good or actually bad or unwelcome. But at least there's some good things to share, which is always a nice thing in tax law changes. And then you might reasonably say, well, what are the things that have changed? What do we need to worry about or be excited about? And I think there's a few. One interesting thing is better rules on what are professional services. Professional services are subject to withholding tax if they're domestic, but the rules on who is a professional have changed and got better, so they won't apply now to things like journalists or security guards. They have their own withholding tax on ordinary services, which will be a lower rate, so that's very welcome. The really good thing, I think, is that a person who suffers withholding tax has an easier time of claiming it now. I think this was always in the law, but it wasn't in the practice. But now it's quite clear that the person deducting must issue a receipt for the withholding tax, and the person who's suffering the tax can then use that receipt to claim his credit, rather than having to run around trying to get tax credit notes, which are something in the law and also quite hard to do, especially for foreign currency tax. It's almost impossible to get. So that's a big improvement. And being able to claim on the strength of that receipt. But it does mean the person deducting has to now not only use my tax per max information and put that on there, but he also has to issue this receipt, and not doing so will be a problem. There's better rules now on when on the penalties and interest when withholding tax is not deducted. People deducting or who should be deducting need to be aware of that. They still don't want to allow grossing up on withholding tax. So if you don't think you're going to be able to claim, or you know you're not going to be able to claim credit for that withholding tax, in many countries you just gross it up and charge the customer more. You can still do it, but you have to hide the thing in the price and agree that higher price with the client rather than having a transparent gross up for the withholding tax. And what else happened? Something not so good. If the supplier who's suffering withholding tax doesn't have a TIN, a taxpayer identification number, then the rate will be doubled. Now, how that works when it's a foreign person receiving the payment, we don't really know. It could be unfortunate. If any argument he needs a TIN, then you better get one. Otherwise, double the rate. Again, that should probably be superseded by double taxation agreements, but who wants to get into a dispute on this? One of the big planning areas in the past in Nigeria was over-the-counter transactions, and people perhaps took a rather generous view of what an over-the-counter transaction was. There's now a definition of it, and it is much more circumscribed and narrow. So then that restricts times when you can use that exemption to not have to deduct withholding tax. I think what is not going to missed opportunity, I think, is that refunds of excess withholding tax are still a problem. There's been some changes proposed in the reform bill, which may help it a bit, but broadly it's a problem. So if I'm suffering withholding tax and the tax exceeds my overall liability, then I need a refund. Now I can claim it, I always could claim it. It was and probably still is a bit of a protracted process, but yeah, it's an opportunity missed, I think. And there's a reasonable argument, I think, in the law for saying that withholding tax should be paid without an audit, because it should be paid straight away if it's excess tax payment. The tax authorities, of course, don't agree, and they want to audit you to death and try and convince themselves that you actually owe them money. The only thing that's slightly good in getting towards this, to reducing the scale of the problem, is that the rate of withholding tax has been reduced to 2%, unless a different rate is defined. So if you're manufacturing goods or selling them, then you get no tax at all. But if you're not in that business of manufacturing goods and selling them, you like to have 2%, but at least that's better than the old 5 or 10%, unless you could show ordinary course of business. And the FRS, Federal Inland Revenue Service of Nigeria, always caused problems around what was the ordinary course of business, despite the Tetra Pak case. So again, going back to what is good and bad, I think overall it's not so good that that definition of ordinary course of business that was set out in the court has been superseded by a change in the law, but 2% is better than 5 or 10. Hopefully one of these days we'll see progress on making it easier to get excess refunds paid. But until then, who knows? So that's the end of that one, Dom, I think. Let's go to the next one. So continuing the series of discussions about recent changes in tax law in Africa or tax practice in Africa, today I'm going to talk about dormant companies. And you might reasonably say now, well, okay, what is a dormant company? Let's get that definition out of the way in the first place. And dormant company, I mean one that's on register with the Register of Companies, but isn't doing very much or seen as not actually trading or being active. And the view on that can vary depending on which side of the fence you're sitting. And I think the overall counsel I would give is don't be too optimistic on what a dormant company is. I think personally it's very difficult to have a dormant company if it's got any assets, for example. And not great if it's got liabilities either. If it's traded in the past, where you've got a reasonable view, if it's stopped doing that, then it is dormant. But the next question then is, why keep it? And the big problem with dormant companies, I think, is that they don't make your compliance problems go away. They may do it, follow some process. So you may be able to convince the tax authority that this company is dormant and shouldn't have to file returns. That could be VAT returns, it could be income tax returns. You've almost certainly still got to file returns with the Registrar of Companies, which means getting the accounts done. And overall, you'll suddenly find that if you have these things lying around and you haven't managed them properly or haven't been doing those annual accounts, you could suddenly find yourself a big bill for penalties and late filing penalties, essentially, both in the Registrar of Companies and from the tax authorities. Worse if you've got a pile of VAT returns, which are monthly or 2 monthly, and then worse still if you had transfer pricing documents, as in Nigeria, which should have been filed for every company but weren't. Even that, those 2 little forms you have to do, and they carry fairly exciting penalties. So, why worry about dormant companies? I think first of all is because what I just said, they can lead to penalties. I think the other thing is it's very easy to forget about because they're not doing anything. You tend to think they're not there. But they're like hidden problems that will suddenly rear up and cause a problem, cause an expensive one, more or less. So the getting to know what they are, what's in the group, what's its status is a good idea. My overall feeling is get rid of them because they cause nothing but problem. It doesn't normally cost that much to set up a new company if you need one. It can take a bit of effort to get rid of the old one. But that process itself will lead to some clarity because you'll think, well, how do I get rid of this thing? What's in it? And what's the best way of dealing with it? And often just deregistering it is not the answer because you could suddenly find that you've got assets in there which become forfeit to the state, essentially. There's a legal term for that. I won't bore you with it, but yeah, there's things to think about. So the other thing we can get a problem with is if that thing's been funded within its company loan, it can't repay it, what are you going to do with it? You don't really need to suddenly have a big income arising from a waiver of a loan, which may or may not be protected by losses because they have time limits on them. There can be restrictions on use of them, all sorts of other exciting things. It's best to think of a better way of doing it. So overall, before killing a company off, you probably need to ensure it's solvent unless you're really in the market for an insolvent liquidation, which can be a nuisance. So I think, yeah, overall, my counsel on dormant companies is get rid of them.